We're here at the Wine Country Conference in Sonoma, benefiting the ALS Les Turner Foundation, and I am joined by John Hussman. He is principal shareholder, president of Hussman Strategic Advisors, the advisory firm that manages the Hussman funds. And we're so happy to sit down with you. Thanks for being here.
Thank you. Nice to be here.
Let's talk about corporate profits, because
Yes.
they are one of the foundations of this bullish case for stocks, that corporate profits are so good. But you point out that they're at 11% of GDP, which is dangerously high and signals a bubble that's about to burst, possibly.
Sure.
Okay, so you'll notice that, first of all, this is during this Sonoma conference, which took place approximately April of 2013. It was also the same conference where, you might recall, I critiqued a interview given by Chris Martenson and showed that the guy's a complete clown. You'll also notice that this individual, Mr. Hussman, is talking about corporate profits being at such a high level of GDP that it's signaling a market bubble. So one must wonder where Martenson got his information from, where he got his theory from. I'm willing to bet he got it from Hussman, because Hussman writes a lot of baloney on his website. All sounds like a good story, you know, because Hussman has a PhD in economics, which means he has a PhD in smoke and mirrors. He can create all these little stories that sound good and so forth, but at the end of the day, these economists don't know how to make money. Believe me, the more they know about traditional economics, the more they have been trained in economics in school, the less chance they're going to be able to make money. This is just my own observation, and Hussman certainly falls into this conclusion quite accurately if you look at his fund performance. Anyway, I just wanted to point that out. You know, Chris Martenson, because I mentioned that this guy, I don't think he does any real original research. I think he just reads from what other people. You know, I think that Hussman probably does original research. He runs funds. He has a lot of money under management, so he has a lot of resources and motivation to do research. It's just that he's clueless. And I'm not talking about making one bad call or having one or two or three or four bad years. Once you see the performance of his funds, you're going to realize this guy is a clown, complete clown. And keep in mind that, as far as I am aware, Hussman, he doesn't run hedge funds. He runs long equity funds. So given that, he should be somewhere around the performance of the indices, right? The indices this year, S&P, NASDAQ, are actually in order of best performing. NASDAQ, S&P, and Dow have returned anywhere from approximately 20 to over 30%. So if you're running a fund, you know, let's say that you try and protect against some risk, and the price that you pay is you're going to miss out on a couple of percentage points from the indices, right? Well, unfortunately for Mr. Hussman, it hasn't turned out that way. He has significantly underperformed. Matter of fact, he's underperformed the indices by more than the hedge fund industry. I mean, it's pretty shocking. Anyway, let's go ahead and listen to what he has to say, and then we'll take a better look at his funds, so you'll see what I'm talking about.
Well, right now, corporate profits are about 70% above their historical norm. Even marginal improvements in the federal deficit, which they're trying to do, obviously, and in household savings, which are necessary because of the debt burdens that households have taken on.
Right.
If you get a little contraction there, we are likely to see about 12% negative earnings growth annualized over the next 3 to 4 years. In other words, a substantial weakness in corporate profits.
What impact would you anticipate that to have on the market?
So what we see is this. We see the Federal Reserve pressing interest rates to zero, causing investors to reach for yield. Right. They feel like they can't sit in zero interest money. They've got to go somewhere. Right. Where do they go? Well, they see this illusory yield, essentially, in stocks, where the yield, the earnings yield on stocks is presumably high and attractive and so forth, and they don't factor in that those earnings yields are about 70% above where they normally would be if corporate profit margins were normalized. And
no, actually, we do factor that in. We understand what's going on, but we're not going to sit around and with our tails between our legs, shaking in the corner year after year, predicting doom and gloom. And if you're doing that, Mr. Hussman, and you're running funds, you are shortchanging your investors. And unfortunately, I have to believe that most of the investors in his funds are pension plans and so forth. Because individuals certainly month after month or quarter after quarter would not be sitting there looking at their account statements, losing money in most cases of his funds while the indices are soaring. They would sell. This is just another example. Mr. Hussman, of course, is and because he's afforded the opportunity of networking, he receives handouts from other fund managers, pension plan managers, mainly public pension plan managers, but also some private, because run those as well. And it's really a disaster what's going on. No one's going to talk about it, of course. You can't talk about these things, right? But chances are, and it's not just Mr. Hussman. Remember, we've got Bill Ackman, who previously managed $14-15 billion. The fund is down now to a little over 12 because of his massive losses. Mr. Ackman has been benefiting his funds from pension investments. In all fairness to Mr. Ackman, his performance longer term has been much, much, much better than Hussman. But my point is that if you are, this is why all these hedge fund managers are, where are they getting their money? They're not getting their money from individuals. Most of the money from the hedge funds, the big funds, it comes from pension plans, it comes from endowments, it comes from institutional investors, qualified institutional investors, that's what they call them, which are basically financial institutions and large professional funds, not individuals.
so they see value where value is not.
But if they're making money, what does it matter?
One of the things that Howard Marks, who is
See, he can't answer the question. I mean, even this bimbo, this airhead moron, who I'm sure she didn't pick to interview him. You know, I don't know why they're interviewing this guy. He's got such lousy performance. He's been so wrong for so long. And in all fairness, although she does mention that his funds, later on she will mention his funds have not done that well, they should post the performance of his funds. But of course, they're not going to do that. But even this airhead raises the issue, you know, well, if people are doing well, what's the big deal, right? Now, the only argument against that is if we're in a bubble, and we're not in a bubble. He's clearly panicking. He's trying to maintain composure, and so he's coming up with some BS. Let's listen to his BS response.
a bond manager, said recently, and is very true, is that as you...
Oh, so he goes to a bond... He's going to quote a bond manager. Well, of course a bond manager is going to say something negative and probably exaggerated and not true about equities, right? It's always the struggle between stocks and bonds.
You increase the prices of a security beyond the growth rate of the cash flows. What you do is you bring forward prospective returns that might have occurred later. In other words, what rising prices do is they bring future returns and they turn them into past returns. And so stocks usually look the best looking in the rearview mirror when they're priced to do worst.
So looking forward, you don't want to be there, even you want to take your profits and you want to get out.
Yeah, I mean, there are some trend following,
What is this guy talking about? I mean, seriously. Remember, this is back in March or April of 2013. And we can take a look just to remind you what the market was doing back then, right? So here you go. This is the beginning of April. And you can see the NASDAQ is up over 20%. This is now October. This is showing data from October 30th, although it's October 31st. Data hasn't come up yet. The S&P is up by over 13% since that time, and the Dow is up by over 7% since that time. And of course, year to date, it's much better performance. NASDAQ is up by over 30%. S&P is up by over 24%. Dow's nearly 20% or about 19%. And of course, Hussman has been bearish for many years now. I'm not quite sure where he stood prior to the financial crisis and collapse of the housing market, but I have to believe that he wasn't as bearish back then, because if he were, then he would have cashed in big time, right? He should have. I mean, you can go through and investigate his funds and see for yourself. Once again, we're going to go through the performance of his funds very briefly here in a minute. Just want to show you. If you follow his scare tactics, you get out of the market, look at all the upside you're missing. Are you kidding me? Listen, if you're scared about some type of a sudden collapse in the market, which is not going to happen, I don't see anything. The market doesn't just suddenly collapse for no reason. There are things that build, and only those who understand the true risks of what is going on will sense these early warning signs. And I can tell you there's not really that many early warning signs for possible collapse going on right now. There are some issues out there globally, no doubt about it, but there's really not much of a sense of all of a sudden of a collapse in the market. There's not really much of a possibility right now, and I don't really see one anytime real soon. That's all another discussion, but my point is that this guy is sitting here basically saying that in its spring of 2013, the market is up big time since then. And, bottom line, look at the performance of his funds, and we'll see the guy's clearly clueless.
Is, yes, stocks can creep higher and higher like they've been doing, but then out of the blue, you'll get a move over a period of 3 to 5 days where you wipe out weeks or months of prior gains without the trend following methods able to get you out because the moving averages are so much lower.
Okay. And how about in your personal...
Okay, so now he's trying to scare you, saying, in a matter of days, you can follow the trend. In other words, when he says follow the trend, he's talking about the bullish trend. He's saying basically you can follow that, and then all of a sudden, in a matter of a few days, you can wipe out weeks or months of gains. So that doesn't matter. As long as the trend remains bullish, it doesn't matter. We've seen this already in the market, by the way, folks. We saw this, right? This period here in 2010. Doesn't look like much of a decline, but there was a large decline in the market. You can see this correction period here, but it rebounded, made a new high. Same thing here. Remember when the U.S. government debt was downgraded by Standard & Poor's on, I believe, August 2011? Remember how the markets reacted? Sold off, big recovery. So, and you can just see from this chart, we're due for somewhat of another correction or maybe even sideways trading. So it shouldn't be a surprise. That's just from pattern analysis, by the way. You can't just go by pattern analysis when you're forecasting a market, but this is one piece of information that you obviously need to consider.
Strategy or the strategy with your funds. It looks like it's been a bit of a tough year, to be honest.
Well,
down 8% in your growth fund.
Over the past 12 months.
Which is weighted with stocks over the past 12 months.
Yeah.
So what kind of has not played out the way you thought it would?
So a good portion of that is actually on the stock selection side, where we're in somewhat more defensive stocks. We're not in home builders. We're not in financials. We're not in materials. We're not in cyclicals. And one of the things that quantitative easing has done quite a bit of is
well, you know what? I'm not in home builders. I'm not in financials. I'm not really in cyclicals, other than really kind of trading it. What are you talking about? Your performance is shit. So you said, you didn't say you weren't in healthcare. Healthcare has been doing very well. Consumer staples and consumer discretionary retail, that's been doing the best other than financials. So why is your performance so bad? Okay, that's what people need to ask themselves. And the less people understand about what's going on in the investment markets, the less they'll realize that these guys are clowns. The financial industry operates so much on ignorance. It operates on the guarantee that you're going to be ignorant about what's going on and that you're going to believe all the bullshit out there. That's the scam behind the financial industry. It's really a scam industry. It truly is. It provides so little value and scams people so much. It's really a disgusting industry.
you thought it would?
So a good portion of that is actually on the stock selection side, where we're in somewhat more defensive stocks. We're not in home builders. We're not in financials. We're not in materials. We're not in cyclicals.
On stock selection, so basically you said that you sucked on stock selection. Listen to me. If you're managing a fund, especially a mutual fund, and of course he manages several, his company does, and you're not good at stock selection, you need to wrap it up and go home. Get out of the business. It's all about stock selection with the mutual fund. Completely. What are you talking about? I mean, this is just shocking. People, mutual funds are very limited. Fund managers are very limited in what they can do with mutual funds relative to hedge funds. Therefore, two most important things to manage a mutual fund, to be successful: stock selection, it's number one. Number two, the ability to bring in more funds. Okay, and that's of course important with all types of funds. In other words, you want to be able to bring in more cash than is redeemed, than the shares are redeemed. Asset management skills are not as important for a mutual fund as they are for a hedge fund. Well, I won't say for all hedge funds. Some hedge funds have different strategies, but the point is that, and I talk about this at length in the Wall Street Investment Bible. I discuss this issue in detail so that people understand exactly what they're getting with a mutual fund. Anyway, that's just pretty shocking to me. So he's basically saying that he didn't expect quantitative easing to help out newer economy stocks.
On the stock selection side, where we're in somewhat more defensive stocks, we're not in home builders, we're not in financials, we're not in materials, we're not in cyclicals. And one of the things that quantitative easing has done quite a bit of is encouraged speculation on, some new economy, some new economic, revival happening. We don't really see that.
So first of all, let me also add, if you're managing a fund and you have not been in financials over the past year or home builders over the past year, you're a loser. If you're a fund manager, you're supposed to jump on the bandwagon of the hot trends of what's going on. He can talk a good game, but the bottom line is look at his results. They're terrible. Okay, here you go. Hussman Funds. And, he wants to entice you by telling you that his funds are diversified. Well, they're diversified, but I guess they're not diversified into financials or home builders or cyclicals or materials. I mean, does that sound like his funds are diversified if he's not in those sectors? Those sectors that he named, I would say roughly comprise 60-70% of the S&P 500. I mean, how is he claiming to be diversified? Sounds like to me that, people could sue him. If you have his funds, you might want to look into suing him because he's claiming that his funds are diversified. All right? No load. By the way, no load doesn't mean jack. All that means is that you're not paying a commission to a broker. No load funds aren't really much cheaper, the fees, than load funds. It's really kind of it's a misconception. I mean, they can be, but it's a misconception. Let's take a look at his fund performance. Okay. Here we go through September 30th. This is fund performance. 1 year, minus 4.72%. 3 year, minus 7.83. 5 year, minus 5.7. 10 year, basically flat. And I'm willing to bet these returns are not adjusted for the fees, the expense ratio. If you adjust these, assuming that I'm correct, if you adjust this for the expense ratio, you're looking at big time losses. Big time losses, especially for, the 10-year. We can go over Mr. Hussman's funds. We can analyze them at a later time. But you can see the performance of his funds, very similar. It's garbage. And once again, 1 year, 8% down. His inception since 2002, 5.3. Now, by the way, keep in mind that September 12th, 2002, that was about a month away from the exact bottom in the stock market. So he got in at the exact bottom after the dot-com-led recession, right? A year after 9/11. He got in at the exact bottom. And after 11 years, people, let me be clear. It should be obvious that just from Hussman's performance, in most cases, you're probably better off putting your money in the bank, in the money market, or even in CDs. Recall just a few years ago, before the financial crisis, the interest rates were, I believe, over 5%. I mean, these guys are parasites. Look at this. Wow. I mean, his performance is just terrible. And the scary thing is, last time I checked, it's been about a year, but I thought he had $3 or $4 billion under management, maybe even $5 billion. I mean, that's just scary, people. What a joke. Once again, let's look at, this is annual return through September 30th, 2013. So let's look at the performance of the indices. Well, here you go. This is trailing 12 months through September 30th. And you can see the Dow was up by about 17%, S&P 19%, NASDAQ 27%. So once again, you're looking at, over the past year, his funds averaged from about, I guess the best performing fund he's got here is, for 1 year, he's got, well, this is through June 30th, it's 5.5%, and then through September 30th, it's 5%. That's the best he's got. Everything else is a loser, is lost. And actually, from a relative standpoint, if you're only returning 5% versus the market indices of 16, 20, 27, and 32%, I mean, come on. Why are you paying someone 1 or 2% in fees for that performance? It's terrible performance. It's abysmal. It's lousy. This is just scary. So this one was July 24, 2000. We'll take a look at that period as well. July. There's November 2012. September 12th, 2012. That's what I have the charts showing back to September 12th, 2012. And this is December. So there's not much difference between December and September. It's shocking that he's starting new funds. Who would give him money? Of course he wants to start new funds over different periods. He wants to try and get lucky. But if you're starting a fund at the market bottom and your performance is this bad, you're a loser.
Some new economic, revival happening. We don't really see that in any of the leading evidence. It's certainly true that we've seen, declines in leading indicators that have normally been associated with the boundary between expansion and recession, and then you get a new round of QE and you recover. And then we've seen it again, and then we've recovered, and then we've seen it again. And that's gone on for about 2-3 years. So signals that normally would have been associated with oncoming recession very quickly have essentially kicked the can down the road.
Right.
What we have not seen is any material revival in those leading indicators that would lead us to believe that this is anything more than a short-term can kick. But we've seen it again and again, and that's, over a portion of this cycle, certainly that's been a problem for us.
Well, of course it has. A short-term can kick over and over again. Doesn't that equate into a long-term can kick? Listen, you can call whatever you want. Fact is that earnings have been at record highs. Okay? You've missed it. You've blown it, buddy. You blew it. Anybody that's in your funds is an idiot, is a sucker.
Our world.
The problem is that guys like Chris Martenson follow this clown. And he gets paid, Martenson gets paid to put people, to endorse or advise people to buy into brokerage firms that also follow this guy. This is a fact. Chris Martenson is referring his sheep into doomsday brokerage firms that have the same approach as this guy, brokerage firms that follow Robert Prechter, that follow this Hussman guy. This is an established fact. How do I know? Because we did some legwork. We know what firms Martinson is referring people to, and we contacted those firms. And that was what we were told. Those firms, one in particular, and I've got it in the Martinson expose piece, which is about 50 or 60 pages long. One of those firms that Martinson shuttles people into, I was told by a representative that they follow Robert Prechter and Hussman. I mean, these guys are like two of the worst ever. I mean, you may as well make it the Three Stooges and add Peter Schiff, right? I mean, unbelievable. Yet, people don't know. They don't know. Listen, people, if you are in a fund that's up 5% and you're paying management fees and the market's up 20%, 30%, I don't know what to tell you if you're staying in the fund. Because if you're not making 20% or more, when the market's up 20%, you're paying some numbskull to get you 5% or even 0% or even losses. Remember, Hussman he's down in some of his funds for the year. You're paying some guy, and you stay in that fund, you deserve to get taken. Okay? It doesn't take a genius to understand the ins and outs of investments and finance and so forth to see that you're in shitty investments. If you market a product towards naive, stupid people who want to believe this doom porn, into the world, all this shit, if you market yourself into that, you can make a lot of money. And that's what these people are doing. Unbelievable. It doesn't pay to market a product, to market your services to intelligent people. Because there's not a whole lot of intelligent people out there. That's the sad reality of what we face today in this world.
There are two fundamental reforms that we need is to get adequate capital and two, to get far higher levels of enforcement of fraud statutes. Existing ones, I'm not even talking about new ones. Things were being done which were certainly illegal and clearly criminal in certain cases, fraud is a fact. Fraud creates very considerable instability in competitive markets. If you cannot trust your counterparties, it won't work. And indeed, we saw that it didn't.
So things went very well, and then the economy collapses. And so all of a sudden people are saying, well, it was Alan Greenspan's fault because he should have anticipated this. Did you think that was fair?
Nobody forecast the 2008 crisis. One of the things I put in the second book I wrote was how the IMF missed it, the Federal Reserve missed it. You go down a whole series of the major forecasting.
Well, everybody got it wrong, let's say.
You can't have a crisis of that nature that is not a surprise. Nobody forecast the 2008 crisis. One of the things I put in the second book I wrote was how the IMF missed it, the Federal Reserve missed it. You go down a whole series of the major forecasting.
Well, everybody got it wrong, let's say.
You can't have a crisis of that nature that is not a surprise. Nobody forecast the 2008 crisis. Nobody forecast the 2008 crisis. Nobody forecast the 2008 crisis. There are two fundamental reforms that we need to get adequate capital and two, to get far higher levels of enforcement of fraud statutes. Existing ones, I'm not even talking about new ones. Things were being done which were certainly illegal and clearly criminal in certain cases, which, I mean, fraud is a fact. Fraud creates very considerable instability in competitive markets. If you cannot trust your counterparties, it won't work. And indeed, we saw that it didn't. Certainly illegal and clearly criminal in certain cases, which, I mean, fraud is a fact. Fraud creates very considerable instability in competitive markets. If you cannot trust your counterparties, it won't work. And indeed, we saw that it didn't. Certainly illegal and clearly criminal in certain cases, which, I mean, fraud is a fact. Fraud creates very considerable instability in competitive markets. If you cannot trust your counterparties, it won't work. And indeed, we saw that it didn't. There are two fundamental reforms that we need to get adequate capital and two, to get far higher levels of enforcement of fraud statutes. Existing ones, I'm not even talking about new ones. Things were being done which were certainly illegal and clearly criminal in certain cases, which, I mean, fraud is a fact. Fraud creates very considerable instability in competitive markets. If you cannot trust your counterparties, it won't work. And indeed, we saw that it didn't. Nobody forecast the 2008 crisis. Things were being done which were certainly illegal and clearly criminal in certain cases, which nobody forecast the 2008 crisis. 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 Nobody forecast the 2008 crisis.
In terms of getting back as an investor, if it's coming down to here, almost irrespective of what's going on, I have to believe, if I have to make a call in advance, and of course I can change depending on what happens, but I have to believe this is where you want to start doing that 18, 17, around there. Their earnings report is a complete game changer, at least for quite a while. Bottom line, NVIDIA now is going to enter the realm of Tesla, Apple, and all these other big, I mean, listen, NVIDIA can come down to 150, come down to $100. You don't think it's possible, then you don't understand how the market works. I mean, listen, NVIDIA can come down to 150, come down to $100. You don't think it's possible, then you don't understand how the market works.